Hi, and welcome to this week's look at the big stories that have affected the market so far. We're going to cover 4 stories for you, as we normally do. Firstly, we'll take a look at the US and the S&P 500, see how that fared after the CPI and inflation data that came out. We're then going to take a look at the Aussie dollar and the New Zealand dollar against the US dollar, see how those two currencies are faring, obviously geographically located quite closely together. Thirdly, we'll swap our attentions to the dollar against the Japanese yen, see how that's been going, a couple of comments on that so far this week. And we'll finish up, much as we did last week, with a story of Nvidia, but a little bit more positive, and obviously one of our most popular shares, FXOpen, so worth taking a peek at that. So we'll start with the S&P 500, and it rose after that US inflation data I mentioned. Now, historically, September is the worst month for the S&P 500, or the US SPX 500, as we call it at FXOpen. And the start of the month was no exception, with the index down approximately 4.5% from the 1st to the 6th of September. However, we had that inflation data out Wednesday, and core CPI was up 0.28% in August. That was against forecasts of 0.2%. Now, despite coming in above forecasts, certainly market participants seem to believe the Fed may well agree to a 25 basis point cut next Wednesday at their meeting. Now, let's take a look at the chart, the US SPX 500 chart at FXOpen, and we can see the price is moving within the ascending channel in blue, having rebounded from its lower boundary on Wednesday and breaking the local descending trend line that you can see in red. Now, the movement from B to C is approximately 50% of that A to B impulse you can see. That's a bullish signal that suggests the normal correction may be complete, indicating a potential rally from the 5th of August low. Now, Wednesday's price drop was a false move. That's indicated by the arrows that you can see, creating a bit of a bear trap. So as of mid-month, the outlook appears positive, and we could possibly finish the month in green despite a pretty poor start, although it's fair to say the Fed decision next Wednesday will play a crucial role in the outcome of whether we continue to push up or something else happens. So don't forget next Wednesday. Now, secondly, we're going to take a look at the Australian dollar against the US dollar and New Zealand dollar against the US dollar. And we've seen both of these pairs trim the gains and are the bears back. When on Wednesday on the website, we took a look at both the Aussie dollar and the Kiwi dollar against the US dollar. We'll start with the Aussie dollar. Take a look at the chart here. It's an hourly chart, FXOpen. We can see the pair struggled to clear the 0.6765 zone and started a fresh decline beneath the 0.6720 support level. The pair even settled below 0.67, the figure, that's 0.6700, and the 50-hour SMA. A low formed around the 0.6640 level and started to consolidate its losses. On the upside, what's the chart telling us? Well, where immediate resistance is near the 0.6660 level, there is a bearish trend line connected with resistance at that level. Then we've got 0.6670, which is approximately the 23.6% Fibonacci retracement level, above which the price could rise towards 0.6700. A close above 0.6720 could see us start another steady increase. Now, the next major resistance around the 0.6765 level, and on the downside, initial support can be found near 0.6640, then 0.6620. Now, if we saw a break below here, then potentially we could see a fall down to the next support level at 0.6550. We're going to flip now to the New Zealand dollar or Kiwi dollar against the US dollar. Again, hourly chart FXOpen. We can see a similar pattern was followed. Settled below 0.6190 and the 50-hour SMA. It tested 0.6125 and then attempted a minor recovery wave. Now, immediate resistance on the upside is near 0.6150. Also, a key bearish trend line is forming with resistance at spot 6155 and the Fibonacci retracement levels. Our next resistance, circa the 50% Fib retracement at 0.6190. And a move above here could lead to 0.6240, then 0.6280. On the downside, we're looking for immediate support near the 0.6125 level, next major support near 0.6080 zone, and a break below here, and we could extend that decline towards the 0.6050 level, and the next key support after that is near 0.6000. So certainly some of those gains being trimmed away. Could be a little bit of volatility. Again, we've got the Fed rates coming out next week. They're going to have some impact, so don't forget your risk management techniques. Okay, for our third story, we're going to stick with currencies, and we take a look at the US dollar against the Japanese yen, and that drops to a new yearly low. Wednesday also saw us take a look at the dollar yen chart, and that showed us that the rate fell below the August the 5th low. Now, it was influenced by comments from a Bank of Japan representative, Nakagawa, who said that the Bank of Japan would continue raising rates. And I quote, said, "Given real interest rates are currently very low, we will adjust the level of monetary support to ensure the sustainable and stable achievement of our 2% inflation target." So obviously, as we've seen across much of the rest of the globe, talks of further rate increases potentially there, etc. Further delve into that chart when it shows, well, since early August, the price has been in that descending channel that we can see in red. And the price has fallen to the median line, which continues to show signs of support. And you can see that with the arrows that are added onto the chart. There are signs that the bearish sentiment is dominant, and that's evidenced by the 143.7 level has shifted from support to resistance. That previously happened with that 149 level that was quite key. We can also see the prices below the resistance 1 trend line. Now, I don't want to harp on about it too much, but obviously this was pre the US CPI data, and at that point we thought the bears may try and push down to the psychological 140 level. Well, circa Thursday morning, the price is around the 142.74 level, so that's not quite happened. But again, talk of inflation from Japan, and of course, the Fed rate announcement next week. Don't forget your risk management technique and keep your ears and eyes open to all the news. Okay, finally this week, we're going to take Nvidia, as I say, one of the most popular shares at FXOpen, and Nvidia shares surged just over 8%. Wednesday, share price closed just below the $117 per share mark. Tuesday it closed at just over $108 per share mark. Now, the stock market positive momentum was a clear reaction to the inflation data we had. There are other factors at play, but certainly gave Nvidia a bit of a boost. Some of those other factors include what their CEO, Jensen Huang, said, and he said that the demand for their new Blackwell chip is so high that some companies Nvidia works with have become, and I quote, emotional, which is quite a statement, really. But let's take a look at the chart. What does that show us? Well, the price is forming an ascending linear regression channel in blue, rebounding from its lower boundary that you can see there. Now, however, the bulls will need to prove their strength, as there is a series of resistance levels that lie ahead for the Nvidia share price. We've got the bearish gap zone around $117 per share. We've got the psychological level of $130 per share. And we've also got the upper boundary of that descending channel that you can see in red coming into play. Now, if the Fed does cut its rates next week and Powell's comments are dovish, the Nvidia stock price could break through this resistance and continue its impressive 2024 rally, which has already seen the price increase by approximately 150% in the first half of the year. And I think it's fair to say that analysts remain optimistic. According to Tip Ranks, 39 of the 42 analysts they surveyed recommended buying Nvidia stock, with an average target price of $153.24 in the next 12 months. So a bit of a contrast, the way we finished with Nvidia last week, or sort of the week before, but certainly one to keep your eye on. It's been positive, and who knows what happens with the Fed next week. The positivity could well continue. We wish you luck. We are trading in the week ahead, and don't forget to check the website out for further and more in-depth analysis. Bye for now.